This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 4 videos on candles, setups, and signal bars. I'll begin by talking about trend bars and trading range bars. Every bar on every chart is either a trend bar or a trading range bar, just like every part of every chart is either a trend or a trading range. Next, I'll move on to talk about signal bars and entry bars. An entry bar is the bar when you placed a trade. The bar before it is the bar that made you want to place that trade. It's the signal bar. It signaled the trade. And finally, I'll talk about bad signal bars. Sometimes the context is very good for a trade, but the signal bar does not look very good. If the context is good, you have to take the trade. Look at these bars. There's some black ones and some white ones. The black ones are bear bars, where the bar opened above the close, and the white ones are bull bars, where the bar opened below the close. It closed above the open. So those are bull bars, and the black bars are bear bars. Some traders prefer to use green for bull bars and red for bear bars. But there's something else about these bars. Some of the bars have bodies that are smaller than half of the size of the height of the bar. And other bars have very small tails. For example, here's a tiny tail on the bottom of this bar, and there's no tail on the top of the bar. The bars that open at one end and close at the other end, where the bodies are at least half the size of the bar, and especially if the bars are relatively big, I call them trend bars. Big bodies and tails that are not particularly prominent. The bodies are at least half the size of the bar. Here are examples of trend bars. And the only other kind of bar that I see on a chart is a trading range bar, a bar in which the bulls and bears were about equal. They have smaller bodies that are typically less than half of the size of the entire bar. Sometimes a trading range bar can be a very big bar, as long as the body is relatively small compared to the height of the entire bar. So trading range bars like this, body is less than half the size of the bar. Some trading range bars have relatively big bodies compared to the size of the bar, but if the bar is small, I still call it a trading range bar. Other bars are extremely big, but have very small bodies. I call those trading range bars. Here are examples of trading range bars. You can see I have a mark on every bar on the chart. So every bar is either mostly a trend bar, in which the market is going from one end to the other, or a trading range bar, in which it goes both ways. And some bars are in between, and you can call them a trend bar. In certain circumstances, you can call them a trading range bar. But in general, I prefer to think of bars as either trend bars or trading range bars, just like I prefer to look at any chart as either in a trend or in a trading range. If you're not certain whether a bar is a trend bar or a trading range bar, look to the left. Look at the context. Well, a small body in a strong trend is more of a trend bar. Here we have 3 consecutive bull bars, and they're all small, but the context is good. We have an II pattern. We broke out a little bit here, and we're starting to form higher lows and higher highs. So this is the early stages of a trend. Even though these bars are small, I would call them trend bars. Close above the middle, close above the middle, close above the middle. Tails, not especially prominent, especially on the bottom. No tails or very small tails. The bulls are beginning to get eager to buy. So those are trend bars. And a bigger body in a sideways market can still be a trading range bar. So look at this bar. Its body is as big as these. These are trend bars, yet this is a trading range bar. It's coming in a series of bars that are mostly overlapping. Most of the bars have very prominent tails, and the bodies are less than half of the size of the entire bar. The context here makes me call this a trading range bar, even though its body is as big as the body of the bull bars here. These are trend bars, and these bars, even though the bodies are the same size as here, are trading range bars. They're occurring in a trading range. Every time the market goes up, it goes down. Every time it goes down, it goes up. So you got 5, 6 sideways bars closing in the middle, prominent tails up and down, even though the bodies are relatively big compared to the bodies over here. The context here, we're sideways, 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 sideways. We're not going up or down. The context is a trading range, and trading ranges are made up mostly of trading range bars. We have all kinds of things going on here. Take a look down here. These bars are not especially big, but look at the bottoms of the bars. The tails are either small or non-existent, and look at the closes of the bars. They're closing above the midpoint or near the high of the bar, and then there's not much overlap from one bar to the next. As soon as the bar closes, the other bar opens and it goes up. As soon as this bar closes, the next bar opens, it goes up. So we're beginning to trend. Even though the bodies are small, they are at least half the size of the bar. And over here we have a big bull trend bar. We have a bear trend bar, a bull trend bar. Is this a trend bar or a trading range bar? I would call this a trend bar. However, it led to a trading range. And these next 5 bars, I think, are all trading range bars. Fairly prominent tails. Even though this bar has a big bear body, it did not close on its low. It closed back up near the midpoint of the bar. If it was truly bearish, it would have closed on the low. Instead, when the market got near the low, probably right before the close, the bulls bought it. And the bears bought it as well. The bears bought it because they were not confident that the market was going down. So the bears lacked conviction. Here we have a series of bear bars comparable to this series of bull bars. We have 3 or more consecutive bear bars closing below the midpoints. We're probably going to get more down. Once you get 3 or 4 consecutive bear bars in a bull trend, you're probably going to go at least a little bit lower. Even though these bars are small, they are trend bars. I would not call these first 2 bear bars trend bars until I see that third bar. It has a bigger bear body, so we're starting to accelerate down. And that tells me that these 2 bars, rather than being the start of a trading range, were instead the start of a bear trend. Sometimes it's very easy to call a bar a trend bar. Here, the bars are big bars closing on their lows, consecutive bars. As soon as the bar closes, the next bar immediately sells off. As soon as this bar closes, the next bar sells off. So the high of this bar does not go much above the close of that bar. That shows urgency. The bears were eager to sell. So as soon as they see a strong bear close, a bar closing on its low, they sell. They sell at the market. Or they'll place a limit order as soon as this bar closes to sell at that close, and the market immediately sells off. Starting to get prominent tails here and here. And then again here, prominent tails, bars mostly overlapping sideways. We're starting to get some trading range price action there. I would call maybe these 2 bars trading range bars. The trend down is so strong, it's unlikely that we're going to go up very far. And the attempt at a trading range failed. We slipped down more. And then the attempt here at a trading range or a reversal also failed. And it became a bear flag. We paused. It's a pause. It's a trading range. A pullback. Remember, a pullback is a small trading range. And a pullback often is made up of trading range bars. Now, every bar is either a trend bar or a trading range bar. Trend bars close near the top or the bottom. They have small tails, and many of them have big bodies. We have a bull trend bar here and a bear trend, and then a series of bear trend bars. And then trading range bars start to become more prominent when the market feels complacent. There's no sense that the price is particularly wrong. There's no sense of urgency that the price has to quickly go to a better location, like in here. The market, anytime it goes down a little, the bulls buy, the bears stop selling. Anytime it goes up, the bears start to sell, the bulls stop buying. Traders know that the market is not going to go very far up or down. And the bars reflect that as well. trading ranges usually are filled with lots of trading range bars. You can see how small the bars are, how prominent the tails are. Compare the size of these bars to these bars. Compare the prominent tails of these bars to these bars. Compare the amount of overlap of these bars to these bars. So not much overlap over here during a trend and a lot of overlap during a trading range. Big tails, small bodies, a lot of overlap with the prior bars, a lot of the bars closing in the middle. Trend bars quickly reverse. So we got a bull trend bar, quickly became a bear trend bar. We have a bear trend bar, quickly became a bull bar. In a trading range, you often get bull and bear bars, but they usually reverse within a bar or two. Something to realize about tails is that every tail once was a strong bull body. When you look at this bar, at one point, this bar was that bar. At one point, the bar traded way up, and this bar only traded down to here. This bar also traded way up, but then traded all the way back down to the open. Every tail on the top of a bar is an attempt at a breakout that fails. It's a failed breakout. At one point, this doji bar was a strong bull trend bar, but the bulls lacked conviction and the bears took control. So the bulls owned it for a while, the bears owned it for a while. And it's a balanced bar and therefore a one bar trading range. Trading range, you go up, you go down. On a smaller time frame chart, if you go to a smaller enough time frame chart, this might have had many reversals up and down, but in any case, it probably was a trading range on a smaller time frame chart. Again, every tail on a bar is an attempt at a breakout. Here, the bulls tried to break out above this bar. It closed back below the high of that bar. Here, the bears tried to break down. They tried to reverse the market, closed back above the low of that bar. Every tail is an attempt at a breakout that fails and reverses. So the market goes down and up or up and down, and it is a trading range. Here's a 5-minute chart, and this is a 1-minute version of what took place on that 5-minute chart. It's easier to see the failed breakout if you look at the 1-minute chart. So look at this up and down on the 1-minute chart, a bull bar and then a bear bar. Over here, a tail on top, and over here, it's a big bull trend bar, and then a bear reversal bar, and then another bear entry bar. Anytime you see a tail, you know on some smaller time frame chart, a reversal is taking place. Here, a tail below this bar. On the 1-minute chart, the market goes down and it reverses up. Every tail is a failed breakout attempt and a reversal. I'm going to talk a little bit now about signal bars and entry bars. Whenever you enter a trade, for example, let's say you sell on a stop below the low of that bar. So you get short on this bar. This bar then is the entry bar. And you took this short because this bar signaled you to go short. You have a failed breakout above a double top. You have 2 legs up, maybe in a trading range, 1 pullback, 2. This bar is telling you maybe you should go short if the next bar trades below the low. So this bar is the signal bar, and you enter on that bar. The strongest signal bars are bars that look like this. The market was trending up, and it reversed down. So the strongest signal bars are reversal bars. And that's true only if the context is good. If this was a strong bull trend, traders would buy below the low of this bar, betting that the reversal will fail. But it's not a strong bull trend. We went down, we went up, we went down, we went up. Maybe we're going down again. This reversal bar, I think, is a reasonable signal bar because it's supported by the context, the bars to the left. Sometimes you get a signal bar that's also an entry bar. So for example, look at this bull bar. It's breaking above a tight bear channel and it's closing far above the high of the prior bar. Yes, it's signaling that traders should go long, but a lot of traders will look at this close and they'll buy the close. And if they do, then they're entering on this bar, and this bar is also the signal bar. And the opposite is true over here. A lot of traders will see the trend accelerating down, and that is a signal to go short, and they'll simply sell the close of this bar. Here we have a sell signal bar, 3 pushes up, 1, pullback, 2, pullback, 3. It's a type of a wedge. It's a fairly tight channel, decent size bear bar. We have very bad follow through on the way up. A bull bar, 2 bear bars, a bull bar, and then 5 sideways bars. This looks more like a bull leg in what will become a trading range. Even though the channel is tight, it'll make traders more willing to sell below a strong sell signal bar. So they'll place an order to go short just below the low of that bar, and they'll get short on this bar. This then becomes the entry bar. Opposite is true over here. We're starting to trend up in a fairly tight bull channel. Every time it goes down, they buy. Every time it goes down, they buy. Every time it goes down, they buy. And every time it goes up, they sell. So we're starting to channel up. This pullback held above the low of the bull trend. This might be a resumption of the bull trend. And here we have a decent buy signal bar closing on its high. So the traders will buy on a stop just above the high of that bar and get long here. They'll sell 1 tick below the low of the signal bar. If it's a Forex chart, 1 pip below the low of that signal bar. And they'll buy 1 tick above the high of this bar. They'll get long on this entry bar. Or if it's a Forex chart, they'll buy 1 pip above the high of this bar and get long on that entry bar. Here, 2 bear bars, 3 bear bars, 4 bear bars, closing on its low, closing on the low. Of the 4 bear bars, all 4 closed at or below the midpoint and 2 closed on the low. This is a signal that the market's probably going at least a little bit lower. Some traders will sell that close. So it's both a signal bar and an entry bar. It does not have to be a reversal bar to be a sell signal bar. And the opposite is true here. 5 consecutive bull bars, and this one suddenly is getting bigger. A lot of traders believe the first reversal down will be bought. They'll buy the close of this bar, or they'll buy the close of the follow-through bar. If they buy this close, this is the entry bar, but they bought the close because it's a strong bull trend bar and the 5th bar up. So it's also a buy signal bar. And it's not a reversal bar. It's not reversing anything. The market is trending up strongly. There's no reversal. Signal bars are common, and a lot of them, in fact, most of them, are pretty unremarkable. They're not strong reversal bars. Here's a buy signal bar, and not a particularly big bull body, but the bear bodies are not all that strong either. You probably don't need a particularly strong bull reversal to reverse this weak bear trend. Here we have a sell signal bar. It's a reversal bar, but the body is not particularly big relative to the size of the bar. So it's not an especially strong sell signal bar, but it's strong enough given the context. Maybe we're in a trading range. Bull bar, doji, not all that strong. Bull bar, smaller bull bar, now bear bar. That might be enough to create a reversal, even though it's not an especially strong sell signal bar. A good trader, an experienced trader, he's going to see setups on every bar, and therefore every bar on the chart is signaling something. You don't have to trade on every bar of the chart, but every bar is telling you something, and a scalper will take lots of trades. You might buy this close, buy that close, buy this close. Every bar is signaling a buy. And the opposite is true here. Once you start to get 3 or 4 consecutive bear bars, traders are going to be entering on every bar, selling, betting that any reversal up is going to be sold. Every bar is signaling lower prices, and traders will sell during every bar. They'll sell at the market. They'll sell bear closes. They'll sell bull closes. They'll sell above the high of the prior bar. A lot of websites show signal bars all over the place. Really good sell signal bars. But look at this. There are no good sell signal bars, no really good buy signal bars. This is a typical chart. Really good, strong signal bars are rare. They are the exception. Yet traders trade every bar. So don't wait for the really great signal bars. If you wait, you'll wait a long time, because really good looking sell signal bars, big bodies closing on the low, they're rare. and maybe only 1% of the bars on a chart are really strong reversal bars. And in this particular case, that's what we see here. Maybe 100 bars, only one is a strong bear reversal bar. Yet traders are trading on every bar on the chart. Waiting for that perfect sell or buy signal bar, reversal bar, is, I think, a waste of time. There are tons of ways to enter the market, and if you know what you're doing, you can pretty much enter on any bar on the chart. And that's the purpose of this course, to try to give you reasons to enter trades, and then also I talk about how to manage trades as well. I said earlier that just because you have a strong signal bar, and here we have a strong sell signal bar that's also a reversal bar, we're trending up, we're reversing down, you also need good context. You need more than just a sell signal bar, because a lot of times sell signal bars will occur in the middle of a trading range and they're not reversing anything. So you can have a big bear reversal bar, but it's in the middle of the trading range. There's nothing to reverse. There's no bull trend. It's sideways market. It'll go down for a bar and then it'll go up the next bar. However, look at this chart. We broke above a prior high and we're reversing down. And we have 3 pushes up. 1, 2, 3. Other computers will say 1, 2, 3. Other computers will say 1, 2, 3. It's a nested wedge type situation, and you have a failed breakout. We have a strong bull breakout, probably a second leg up. Well, we got the second leg up, and the second leg up is reversing. The context here is good for traders looking to short. Is it perfect? No. A fairly tight bull channel. We could go up for another leg, but we have nested wedge. We have 2 legs up in what might be a trading range. We have a failed breakout. It's probably about as good as you're going to get. If you want higher probability, wait until you start to see a series of bear bars and then sell. You trade off risk for probability. So if you're selling down here, your stop is still up here, which is further away than for the bears who sold here. But that's always the case. Here you're taking a lower probability trade, so you have better risk reward. You have smaller risk. Here you're taking a higher probability trade. The probability at this point, after an 8 bar, 9 bar, 10 bar bear microchannel, probability is first reversal attempt will fail and will go lower. Shorting anywhere down here, higher probability of making money, but worse risk reward. There's less profit remaining in the trade, and your stop is further away, so your risk is greater. If you insist on waiting for perfection, you're never going to trade. And you need to trade to make money. Just look for something that looks reasonably good, and look for something where you think you can structure a trade that has a good trader's equation. Is the reward big enough for the risk? Is the probability high enough to warrant that risk reward? Most traders should be entering mostly with stops. You can sell below the low of this inside bar or below the low of that bear bar. Same thing here. Or you could even start selling bear closes after you start to get 4, 5, 6 bear bars without a pullback. You're probably going lower. What are the components of a strong sell signal bar? Well, you want an open at or above the close of the prior bar. Here we're opening at, maybe slightly above the close of that bar. And you want a close well below the close of that bar. You want the market to close over here, trade up, and then trade down well below the close of the prior bar. And you also want a small or non-existent tail on the bottom. You want the bar to be closing on its low. Ideally, you want the tail on top to be about 1/3 to 1/2 of the height of the bar. Again, these perfect bars are rare, so don't wait for them. But when you see them, they have a higher probability of leading to a profitable trade when the context is good. Another thing that I always like to see is a close that reverses the closes and lows of many other bars. And that's not the case here. This close just reversed the low of this bar. We closed below that low, just reversed 1 bar. But sometimes you'll get a signal bar that reverses the prior 10 or 15 bars. I also want to see good follow through. The follow-through bar is the bar immediately after the entry or the sell signal bar. So here we have a sell signal bar. And not particularly good follow-through here, but then we got good follow-through here and good follow-through here. So sometimes the follow-through does not come immediately after the strong bear reversal bar, but as long as it comes soon, the odds are the market will go lower. So here we initially had bad follow-through and then bad follow-through again here, but then we got over here 6 bars without a bull body. The follow-through is getting stronger, and it increases the chances that the market will go at least a little bit lower. What's a good buy signal bar? Well, first of all, you want an open of the bar near or below the close of the prior bar. And this open is just around that close. And you also want pretty good context. And here we have a low, we have another low here or here, and then another low here. We're starting to accelerate downward, so it's a parabolic wedge. And then here we went up, and we went down, went up. We went down twice. Down, up, so a micro double bottom. That increases the chances that the reversal will work. So the context is pretty good. I also like to see close well above the prior bar's close. And the tail on the bottom, ideally, you want it to be a third to a half the size of the signal bar. Also, I prefer the bar closing on its high or having only a small tail on top. Once you enter, I want pretty good follow-through buying. You buy above this bar. Now we have a micro double bottom, so a slightly higher probability buy, so you get long here. So far, bad follow-through. You don't want to see that. However, here we're starting to get 3, 4, 5 bull bars. This is good follow-through. So the follow-through is coming a little bit late, but that's still okay. Again, this is not particularly good follow-through here. I mean, it's bad follow-through here, but we soon got very good follow-through. So this increases the chances that this pullback will be followed by higher prices. I now want to talk a little bit about bad signal bars. A weak signal bar can still be good. It can still lead to a good trade. Ideally, you don't want to see too much overlap with the prior bar or bars. Ideally, you'd like to also see a close that reverses several other closes. In other words, if you're looking to buy, you would like the signal bar high to be above certainly the close of the prior bar, but preferably above the close of several prior bars. And I want to see good follow-through. It's better if the bar after the signal bar is also a strong signal bar in the direction that you want to take the trade. Preferably not a doji bar, not an inside bar, not a reversal bar. For example, if you want to buy, you don't want to see a doji bar, you don't want to see a bear body, and you prefer not to see an inside bar. You want the market to race up right away. So this is not an ideal signal bar. The bulls did get good follow-through. They entered on this bar as the bar went above the high of this bull buy signal bar, and eventually they got some pretty good follow-through. A weak setup still led to a profitable trade. Good signal bars are common, but good signal bars with good context is not common. Context means all of the bars to the left. For example, here's a good-looking buy signal bar, but it's following 4 bear bars, and a couple of them are pretty big. So good-looking buy signal bar, terrible context, bad buy. Another good-looking buy signal bar, but still probably part of a bear flag. So good bar, bad trade. Here you got a good-looking sell signal bar, but the context is bad. We just had a reversal up. Good sell signal bar, but bad context, bad trade. And at the low, we got a good reversal up, but look at the buy signal bar. It has a bear body, prominent tail on top, not a good-looking buy signal bar, yet it resulted in a profitable trade. If the context is good, even a bad signal bar, one that looks like this, can lead to a good trade. The better the context, the less important the signal bar. And here the context is pretty good. You got a nested wedge. We got one push down, two pushes down, three pushes down, and this third push down subdivided into three pushes as well. 1, 2, 3. And you also have a series of consecutive sell climaxes here, 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 here. And when you have a series of consecutive sell climaxes, usually the market is too far oversold and you're going to get profit taking on the part of the bears and you'll get aggressive bulls buying. Nested wedge bottom, trying to reverse up from the third push. 1, 2, 3, third push. 1, 2, or 2, and then 3. Context is very good for a buy here. But the signal bar is bad. It's also the 6th consecutive bar down. 5 of the bars had bare bodies. Not a great setup for the bulls, but the big picture is good. Over the past 5 to 10 years, computers have come to dominate trading, and now they create most of the volume. And they are much more interested in the context, the bars to the left, support and resistance. And the result is more and more trades now that are profitable come from setups with very bad signal bars. Signal bars have become less important. Because of the computers buying at support, selling at resistance, you often get very abrupt reversals. And a lot of times you won't have a good buy signal bar at all, but then you'll have a huge bull trend bar. We don't have that here, but that's common. You often get a very good, very violent reversal up without a good buy signal bar. Some traders look at this and say, I want to buy. We have consecutive sell climaxes. We're reversing up from the bottom of the line. We keep reversing up from it. We're probably going higher, but they can't get past this bad buy signal bar. They look at that bear bar and say, I don't want to buy above a bear bar, but I know it's going up. Well, one way to get around that is don't look at a candlestick chart. Just put up a bar chart, and you don't see the bear bar. All you see is the context. You see a wedge bear channel with lots of climactic activity, and now you have a second entry buy. First entry above this bar, second entry above this bar. You just place a stop to get long above the high of this bar, and you get long right here. And if you're looking at the bar chart, you don't see that it's a bad buy signal bar. All you see is good context, and that's all you need. You can either take the trade, or if you're looking at a candlestick chart, you can wait for signs of strength and then buy a close or buy a bull flag. We have a reversal up, we have a pullback. You can buy above the high of that doji bar for a second leg up. If you are looking at a chart where the signal bar is not good and you're unable to take this first trade, the stop entry trade, wait for the breakout, and then the probability of higher prices is high, and you can buy at the close. You can buy below this bear bar, betting the bear reversal will fail, or you can buy above the high of this small bull flag, betting on a second leg up. Whenever there's any kind of a reversal up, there's always a good buy signal bar on some time frame and on some kind of chart. For example, if I look at a 1-minute chart and I see a bar closing on its high, and then I see another bar closing on its high, and then a third bar closing on its high, and I'm expecting a reversal, well, chances are there's some time frame that has a perfect looking or very good looking buy signal bar. Here we have 6 bars closing on their highs. There's some chart, might be a 2-minute, 3-minute, 5-minute, 6, 7, 8, 9, 10-minute, 13-minute, 17-minute chart. There's some time frame where one of these bars will close at the top of that particular time frame and give you a good buy signal. You don't need to know that. You don't need to find that chart. You know the context is good, and if you want, just look at a 1-minute chart, and as soon as you see 3 bars closing on their highs, chances are there is a very good buy signal bar on some chart. Just place an order to go long above the high of that third bar. You can check different charts. Here's a 12-minute chart, and you get a very good looking buy signal bar, and the context is pretty good. 3 pushes down, 1, 2, 3, and the third push subdivided into a micro wedge. Again, do not look at all of these charts hoping to find one that has a good looking buy signal bar. You know that just looking at this, there's going to be some chart with a good buy signal bar, and just looking at this, you know the market's going to go up at least a little. Some traders are always searching for perfect buy signal bars. They'll look at tick charts. They'll look at volume charts. They'll look at all kinds of different time frames. And if they look at tick or volume charts, they try many different bar sizes until they find one that has a very good looking buy signal bar. So for example, if I look at a 1500 tick chart, this is what I get. A pretty good buy signal bar for a wedge bottom, 1, 2, 3. If I trade 7,000 contracts per bar, I also get a good buy signal bar. Why 7,000? Well, I had to experiment. 5,000 didn't work. 2,500 didn't work. If you keep looking, you're going to find some tick chart or some volume chart that has a very good looking buy signal bar whenever you're trying to buy. I had friends years ago who used to use tick charts with Fibonacci numbers. I forgot what the numbers were, but like 367 or 512. They believed that those bars were somehow better than any other bar, and that's nonsense. If you're looking for a good buy signal bar and there's a reversal, and you look at enough charts, you're going to find the bar. However, if you spend all that time looking for the perfect buy signal bar, you're probably going to be too late to take the trade. There's always a good buy signal bar on some tick chart or some volume chart. It's a waste of time to search. Beginners do that because they're desperate for reassurance. They're afraid to take the trade. And if they find that good looking buy signal bar, they'll feel like the trade is better. It's not any better. I say that because there's always a good buy signal bar when you're looking to buy. If you look at enough charts, you'll always find one. Finding one does not make the trade any better. The context makes the trade good. I began by talking about trend bars and trading range bars. Every bar on every chart is either a trend bar or a trading range bar. I then moved on to talk about signal bars and entry bars. A signal bar is a warning that you have a potential trade, and an entry bar is the bar when you actually entered the trade. I made the important point about bad signal bars. They've become much more common over the past 5 to 10 years now that computers dominate trading. If the context is good for a trade, take the trade. Don't worry about the signal bar. Also, it's a waste of time to look at a whole bunch of charts trying to find one with a perfect signal bar. If you look at enough charts, you're always going to find a good buy signal bar. So if you're looking to buy, don't waste your time looking for that chart. You know it's there. Just take the trade. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 4 videos on candles, setups, and signal bars. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on candles, setups, and signal bars. I'm going to begin by talking about reversal bars, bars that lead to potentially trades in the opposite direction to the current trend. And then I'll move on and talk about reversals that take place over the course of several bars, multi-bar reversals. Finally, I'll talk about inside and outside bars. When a trader is looking to buy with a stop, a good signal bar is a buy reversal bar, and the minimum needed is a bar that has a close above its midpoint. So for example, here we have a bull trend, and then we have an attempt to reverse. It's not a very good attempt, and it closed above its midpoint, and therefore traders will look to buy a resumption of the trend. They'll place a buy stop just above the high of that bar, and then they'll get filled right here. This is not a bull reversal bar because it has a bare body. So it's a bare bar, but it is a buy reversal bar. It's reversing an attempt to reverse the trend. So the bulls are reversing the market back up again. And you see that by the bar closing above its midpoint. Down here, here's another type of buy reversal bar. This one has a bull body, and therefore it's also a bull reversal bar. It closes above the open, and in this particular case, it also closed above its midpoint, which makes it a higher probability bet that the market will continue up. The market was going up, pulled back for a couple legs, 1, pulled back 2, And now we have a small double bottom, 1, 2, and the bull trend is trying to resume after about a 50% pullback. So bull trend, 50% pullback. We have a double bottom here. We have a micro double bottom here. We have a pair of bull bars, this one closing above its midpoint. And that is a buy reversal bar, betting that the market will resume up. You place a buy stop to buy just above the high of that bar, and you would get filled on this bar. Here are some other examples of buy reversal bars that are not bull reversal bars. So we have a bear trend, a little bit climactic here, and then much more climactic here. And the market sold off. And then by the end of the bar, it completely reversed back to where it started. It closed above its midpoint, so it's a buy reversal bar, but it does not have a bull body. And here's another example. The market is trending up, has 2, maybe 3 small legs down, double bottom here, higher low. We have a major higher low here that led to a breakout to a new high. And it has a bull body. This is a reasonably good buy. Bear channel, bull flag, especially since it's above this higher low and above this one as well. Whenever you have a buy signal and the signal bar has a bull body, it has a higher probability of leading to a profitable trade than a bar that does not have a bull body. Here we have a close above the midpoint, but no bull body. It did, in fact, lead to a very profitable trade. Here we have a bull body, but it's a very small bar. It's a doji. So not an ideal bar either, but still led to a profitable trade. What's the best type of buy signal bar? Well, a strong bull reversal bar. And here we have a bear trend, a very strong breakout above the bear channel, a very deep pullback to slightly higher low. You can call it a double bottom. You can call it a higher low major trend reversal. And you have a very strong bull reversal bar. It's a bull body. It's a big bull body. It closes well above its midpoint. It closes near its high. Those are all things that increase the probability of a profitable trade. A trader sees that bar. He sees the context, a double bottom major trend reversal. He places a buy stop to go long and gets filled here. He places a buy stop to go long above the high of the buy signal bar, and he gets filled on the next bar as it goes above the high of the signal bar. Ideally, you want a lower tail that is about 1/3 to 1/2 of the height of the bar, and you want a small or non-existent upper tail, which is the case here. But it also did not overlap the bar before or 2 or 3 bars. In other words, it's not a tight trading range. And that is good. And in addition to a good buy signal bar and good context, you also want to see a good entry bar, which is the case here. That increases the chances of higher prices. And you want to see follow through after that. You want to see a series of bull bars. That has the highest probability of leading to higher prices. Buy signal bar, bar entry bar, and then the next bar is the follow through bar. And it's also a good bull bar, decent sized bull body closing on its high. In other words, the entry bar and the follow through bar, they're not bear bars. They're not doji bars. They do not have big tails on top. And that increases the probability that the market will go higher. The best sell signal bar? Well, it's a bear reversal bar. Here, we have a bear trend. Now we have a bull trend, but we have a buy climax and a double top, slightly lower high, 2 legs up in a trading range. We have 2 legs up, 1 pullback 2, 2 legs down, 1 pullback 2, 2 legs up, 1 pullback 2. And after 2 legs in a market that looks like it's in a trading range, traders start looking for reversals. And here we have a second leg trap. We have a first leg and then a pullback, and then a very strong second leg, making traders believe the market is beginning a bull trend. But instead, it did not get above the top of the bars to the left, and it's probably just a buy vacuum test of the top of the range. And you can see the follow-through bar. Instead of another big bull bar closing well above the top of the range, it's a bear reversal bar. It opened near or above the close of the prior bar, and it closed well below the prior bar's close, in this case just a little bit below, and the tail about a third to a half the size of the bar, and the body reasonably good size. No tail or very small tail on the bottom. So that's the sell signal bar, and bears will place an order to sell just below its low, and they would get filled on this small bear bar. That's not a particularly strong entry bar for the bears. It's small. However, a lot of times after a buy climax, the reversal begins with 2 or 3 small bars before traders finally give up, the bulls finally give up. Again, not much overlap with the prior bars. It overlaps obviously the bar before, but not the bars before that. It's happening at an extreme, not in a tight trading range. Sell signal bar and good follow-through bar closing on its low. So now we have 3 consecutive bear bars closing on or near their lows at the top of a trading range. To me, that means we're probably going lower. The market's probably always in short at that point. What's the minimum that a trader needs to see for a sell reversal bar? Well, a close below the midpoint. Here we have a small bear bar. We have a bear trend, 5 bars down, 6 bars down. And we tried to reverse, not very strongly. So it became a bear flag. And traders look to sell. They like to sell below bear bars. So here is a bear bar. They'll sell below that. Here we have a small double top bear flag. They'll sell below that bear bar. Even though these are not particularly strong bear bars, they are bear reversal bars. They're reversal bars. They're reversing the attempt at a bull trend. And they are bear bars, so they're bear reversal bars. That's unlike this. We're still in a bear trend. Now we have a double top bear flag, so it's a double top in a bear trend, so it's a double top bear flag, but it has a bull body. However, it closed below the midpoint or around the midpoint, and therefore it's a reversal bar. The bull trend is failing, and it might be reversing down. Traders see that as a potential sell signal, and they'll look to sell right below the low of the bar, and they get filled here. While it has a bull body, it's still a reversal bar. The bulls are failing, and it looks like the market will reverse back down. Here, it's a sell reversal bar, but it's not a bear reversal bar. Here, bear bodies, they're sell signals, so they're sell reversal bars, and they're bear reversal bars as well. Remember, not all sell reversal bars, not all sell signal bars have bear bodies. Look at this bar. We got 3 pushes up, 1, 2, 3. We're at a lower high. You can call it a double top. In any case, it did not break above the top of the sell climax, the top of the bear trend. 3 legs up, so it's a wedge top. It's a sell signal bar, not especially strong because this channel from here to here is very tight. The pullbacks are very small. Usually when you get a sell signal after a very tight channel, the channel is tight all the way up. Not much selling pressure. A lot of bull bars, not many bear bars. When that's the case, it's usually better to wait for a second entry short, which would be below this bear bar. We tried to reverse up here. We got a small double top. Traders will sell below that bar and get filled right here. This is a sell reversal bar, but not a bear reversal bar. So it's not as reliable. And again, very little selling pressure on the way up. Where are all the big bear bars? There's one, but not much else. We have a couple small bear dojis, but that is not enough to reverse all of these big bull bars. In general, the first reversal down will be minor, leads to a pullback, a bull flag, or a trading range. And if a trader is looking to short, it's better to short below a double top. We tried to reverse back up here and immediately reverse back down when we fell below a reasonably good bear bar. So that would be a short. It's a sell reversal bar closed below the midpoint. That's the minimum needed. Again, not enough reason to sell. Here's another example. We have a double top, slightly lower high, 2 legs up, 1 pullback 2. We might be failing. The bull trend might be failing. Not enough bars for a major reversal, so it's a minor reversal at this point. However, it did lead to a major reversal, as sometimes is the case. This is not, I think, a good enough reason to sell. I personally would not sell below that. A minor reversal, more likely bull flag than bear trend, but sometimes you get a bear trend. And once you start to get 2 or 3 consecutive bear bars, the body's getting bigger, closing on their lows. These 3 bars totally reverse that. At this point, I think the market is always in short, and we're probably going lower. I would not sell below the bull bar. I think if a person was suspicious, let's say there were things on the left that we do not see, that makes it more likely that we're going to reverse down. If a person did want to sell, I would wait and sell below a bear bar, below this bar. So now we have a 2-bar reversal, up, pull back down. On a higher time frame chart, it would be a reversal bar closing on its low. So if you're taking a stop entry sell, I would do it below this bear bar, get filled here, not below this bull bar. Or you wait for 2 or 3 bear bars and then you start to sell closes. That is a higher probability sell. Sell below a bear bar closing on its low if you're looking for an early entry. Early entry, the risk is small, maybe here, maybe above here, but so is the probability. A later entry, after you've seen the bulls give up, entering here or above this reversal attempt or below that bear bar, is a much higher probability short, much higher chance of making money. But the trade-off is risk. If you sell this close or above this bar, your stop is up here, your risk is greater. Whenever you get a setup that offers you higher probability of success, your risk-reward profile is always going to be worse. It doesn't matter if you take this trade where you're going to lose more, or take this trade, in which case you're going to win more often. The trader's equation comes out to be about the same for both. Here you lose more often, but you lose less, and your reward is bigger. Here you lose less often, but when you lose more, and there's less profit remaining in the trade. Both are acceptable. Sometimes reversals take place over more than 1 bar. Every signal bar in a pullback or in a flag is a reversal bar. And when the reversal takes place over 2 or more bars, it's a 2-bar reversal or a multi-bar reversal. So look at this. We sold off, we reversed up. Let's say this is the 5-minute chart. We sold off, reversed up. We reversed over the course of 2 bars. It's a 2-bar reversal. And if you look at a 10-minute chart, this is what it looks like. It's a reversal bar on a 10-minute chart. It's not always the case, because if the 5-minute bar does not end exactly at a multiple of 10, like 10 minutes after the hour or 20 minutes after the hour, it will not look like this. However, you should think of it as a 2-bar reversal and as a reversal bar on some higher time frame chart. It's a good buy above the high of that bar right there, assuming the context to the left, which we do not see, supports buying. Reversals can take place over the course of more than just 2 bars. And the bars do not have to be consecutive. Just think of it as a reversal. We're going up, we're going down. So the market reversed. We have a strong bull breakout and a strong bear reversal. Here's the bull breakout. No reversal here, but we did get the reversal here. On some higher time frame chart, this 6 or 7 bar pattern is a bear reversal bar. Look down here, a bear breakout, and we reversed up a few bars later. Here's a 4-bar pattern, and it's a reversal. So it's a multi-bar reversal. And on a higher time frame chart, you can find some chart where it's a perfect reversal. It's not worth doing that. You just know that whenever you got a reversal that takes place over many bars, if you look at a higher time frame chart, you'll find a perfect bar. So let's say this is a 5-minute chart. Maybe you look at a 15, 20, 30-minute chart, 22-minute, 25-minute, 27-minute, doesn't matter. There's some chart where this is a very good looking single reversal bar. Again, do not do that. All you do is look at the chart in front of you and try to understand what the market is doing, and then look to enter based upon what's in front of you. Otherwise, you might have to look at 10 charts to find the perfect bar, and you'll be missing the trade. You will not take the trade. You'll be so concerned about finding the perfect bar that you will not be devoting enough energy to placing the trade. Again, we're selling off strongly and we reversed up strongly. Not a good buy signal bar here, but a pretty strong reversal. This bull trend bar is reversal. And if you look at some higher time frame, I'm sure you can find some time frame where we have a sell-off and a bull trend. It creates a perfect reversal. This, for example, is a 5-minute chart, and you can look at a 7, 8, 9, 10, 11, 12, 13, 14, 15-minute chart. Here, it turns out, if you look at a 15-minute chart, you have a very strong bull reversal bar. And likewise, if you look at a strong reversal bar like this, you know that on some smaller time frame chart, it's a 2-bar reversal or a multi-bar reversal. Whenever I see a 15-minute reversal bar like this, I know that if I look at a 5-minute chart, the reversal took place over at least 3 bars, because a 15-minute chart is made of 3 5-minute bars. And if I look at a 1-minute chart, the reversal took place over 15 bars. So every good reversal bar is a multi-bar reversal on a smaller time frame chart. I treat every 2-bar reversal as the same as a single reversal bar, and I trade them the same. Again, they form a single reversal bar on a higher time frame chart. Here's a 2-bar reversal down and up, but it's spread over 3 bars. You can call it a 3-bar reversal. You can call it a 2-bar reversal spread over 3 bars. Doesn't matter. You know the market is reversing. Every 2-bar reversal, it's a reversal bar on a higher time frame chart. And again, you treat them like any other signal bar. It does not matter if they take place over 2, 3, 4, 10, 20 bars. All that matters is the market's trying to reverse. 2-bar reversal spread over 5 bars. We sold off and then we rallied. I would not call that a 2-bar reversal. I would simply say, oh, it's a reversal. Three bars up, a breakout, very strong breakout. On a higher time frame chart, it would be a single bar. It turned out to be a climactic end of the trend, but it would be a single bar on a higher time frame chart. Here we're rallying, but look what took place over here. We reversed. On a higher time frame chart, this would be a single bar. On some higher time frame chart, this would be a single bar. And this entire thing is a reversal. We went up strongly, we went down strongly. This reversed that rally. And it took place over whatever that is, 8 bars, 10 bars. And the key point is the market reversed. It tried to go up strongly and it went down strongly. So this reversed that. Multi-bar reversal spread over the course of many bars. I'm going to talk a little bit about inside bars and outside bars. Look at this bar compared to the bar before. Its low is at or above the low of the prior bar. Its high is at or below the high of the prior bar. So this bar is inside that bar. We rallied, we sold off, but it looks like we're bouncing. And look at this bull bar. Its low is at or above the low of that bar. In fact, it's a little bit above it. And its high is clearly below the high of that bar. So it's an inside bar. And inside bars, in a good context, often are good signal bars. It's a type of 2-bar reversal where the second bar is small and it does not reverse much of the first bar. However, it's the start of a multi-bar reversal. So down and then reversed up. And the reversal up was bigger than the sell-off down. Context is good. Whenever I'm looking to buy or sell, I always look to the left. I want to know what the context is. Does it make sense to buy? And here we have a strong bull breakout and a bear reversal, but we have a bull bar after the bear reversal. So that increases the chances that this bear reversal is going to fail. Also, it's a slightly higher low. It's a test of the bottom of the buy climax. We went a little bit below it, but we held above the bottom of the bull trend. So the context is good for the bulls. We have a bear breakout that is failing. Instead of a big bear bar for the next bar, we have a bull bar closing on its high. This is a buy setup. It's a type of double bottom and slightly higher low, which makes it an even higher probability buy setup. Look at this bar. Its high is above this bar. Its low is below the bar before it. It doesn't matter if it's above, as long as it's at or above. It doesn't matter if this is below, as long as it's at the low or below. Then this is an outside bar. It's a reversal. In this particular case, we went down and we went up. Do you buy as it's going above the top of the bear bar? In general, I do not. If this was a good buy signal bar and we went outside of it and above its high, then I would buy as this bar goes above the high of this bar. But in general, I'm not looking to buy as the market goes outside up. The context has to be good, and the prior bar has to be a good reason to buy. This is not a good reason to buy. I prefer to buy above bull bars. If I'm buying and I just look at these two bars, where am I going to buy? Am I going to buy on a stop above this bear bar? No. I might buy on a stop above the bull bar, because in general, if I'm buying with stops, I want to buy above bull bars. Here we have an outside bar. Its low is below the low of the prior bar. Its high is above the high of the prior bar. It has a fairly big tail on top. We're getting a bull reversal here. We have a slightly lower low reversal. And then we broke strongly to the upside. And this is a pullback. We have a micro double bottom bull flag. Not a very good looking buy signal bar here. Also a big tail on top closing at this high instead of closing above it. And this bar did not close on its high. Not a particularly strong buy signal. However, would bulls buy on a stop above the high of that bar? They might. This reversal up is strong enough so that traders think it will go higher. However, because this bar is not a good signal bar, this bar closed at and not above that bar. This bar did not close on its high. The rally is probably not going to go very far. We have a double top and we have a pullback from the test. And we have a micro double bottom, all good. The close is above the high of 2 bars, which is better than simply being above the high of 1 bar, but it did not close above the top of the bull leg, and it did not close above the double top, so it's not especially strong. Good follow through, a bull bar closing on its high, well above the prior high, well above the double top. At this point, the market is clearly always in long. Odds are we'll get at least a little bit more up. Bears are hoping that it's a second leg trap, leg 1 pullback, leg 2. But here we have 2 good bull bars, the second one even better. Good sized bull body closing on its high, closing over the highs of the past 20 bars. More likely, we're going to go higher. At a minimum, traders are looking for some kind of a measured move up, maybe based upon the open of this bar to the close of that bar, maybe based upon the low of this bar to the high of that bar, right here. And ultimately, the market worked up. Tight trading range, it's a warning that the rally might not be strong, but the odds are we're going higher. The same right here, another tight trading range, but no clear top. And the pullback here, while it fell below this low, this is a minor higher low, it did not fall below this low, a major higher low that led to a strong breakout. This higher low did not lead to a strong breakout, so it's minor, and probably this rally is part of a trading range and not a resumption of the bull trend. This is a strong bull breakout to a new high. This is probably the start of the bull trend resuming up, and traders do not want to see the market fall below the bottom of a major higher low, because then their premise of a resumption of a bull trend is no longer valid. The market then is probably either in a trading range or even a bear trend. Trading range, you could say bull trend, bull flag, bull breakout, and went to a new high. And as soon as it got to the new high, what happened? A huge outside bar. The high of the bar is above the high of the prior bar, and the close of the bar, of the low of the bar, is below the low of the prior bar. But more than that, the bar closed below the low of the prior bar. It closed below the low of this higher low. It closed below the low of the past maybe 30 bars or so. So this is a very strong bear bar, and the market probably is always in short. We went up, and then we went down. So this is a large reversal, and this one bar is enough to make traders believe the market will probably go at least a little bit lower. How much lower? Well, I'm always thinking in terms of measured moves. Maybe a measured move based upon the height of the trading range, maybe a measured move based upon this double top. Who's selling here? The bulls are clearly giving up. So the bulls who bought above there or who bought anywhere in here, once it starts to fall, they're giving up. They're selling. The bears know that, and the bears are selling as well. This happens quickly. Remember, at one point, this was a bull bar, and traders are thinking it's going up, and then immediately it reversed down. So you have to be thinking about this so that you can act quickly. You could sell on a stop below the neckline of the double top this high, that high. This is the neckline. And it's a bigger double top, this high, that high, and this is the neckline. This is the lowest bar between the double tops. That is also a sell signal. A lot of traders find it very hard to sell when they're thinking the market's going up, 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 and then it reverses so quickly. If you're not able to sell as it's forming, then wait. You could always sell the close of the bar, or you could wait a bar or two for a bear flag. And here we have a pair of doji bars, a weak attempt to reverse the bear breakout. More likely a bear flag than a bull reversal, so traders will sell on the stop below that, below the prior bar. They'll sell here. Now we have a double top in a bear trend, so a double top bear flag, a good looking sell signal bar, they'll sell here. Here we have a triangle, 3 pushes up, 1, and then 2, and then a third bull bar, 3. That's another sell signal. In this video, I talked about reversal bars. I then talked about reversals that take place over 2 or more bars, multi-bar reversals. And finally, I talked about inside and outside bars. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 4 videos on candles, setups, and signal bars. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on candles, setups, and signal bars. In this video, I'm going to talk about tight trading ranges as setups, and I'm also going to be talking about II patterns and breakout mode. Here's a tight trading range, and if the context is bad for a breakout, then more likely the trading range will continue. After about 10 or 20 bars, when a range is extremely tight, traders should just not trade. They should simply wait for the breakout, because after you have 10 or 20 bars, chances are you're going to have more bars before there's a breakout. And when the range is very tight like this, it's very difficult to make money, even scalping with limit orders. Better to wait for the breakout. Sometimes early in a tight trading range, there can be a buy signal bar. And if you get a buy signal bar in the bottom third, sometimes it's worth taking if the context is good. If you get a sell signal bar in the upper third, it's sometimes worth taking if the context is good. In the last video, I talked about an inside bar, a bar where the high is at or below the high of the prior bar, and its low is above or at the low of the prior bar. So this is an inside bar. And it's followed here by a second inside bar. This bar, its high is at or below the high of that bar. Its low is at or above the low of this bar. So we have an inside bar and then a second consecutive inside bar. And I call this an inside-inside pattern or an I pattern. So there's an inside bar. And then we have a second consecutive inside bar. The same is true over here. Inside bar, consecutive inside bar, so it's an II, and this is an II as well. Sometimes you get a third or even a fourth consecutive inside bar, so you can get an III or an III. And it really does not mean any more than simply an II. IOI, very common if you have an inside bar. This bar is inside that bar. Very common that this bar is actually an outside bar. Its high is at or above the high of the prior bar. Its low is at or below the high of the prior bar. To me, this is an inside bar inside of this bar, and this bar is an outside bar. It's outside of that bar. So we have IOI. So this bar is inside of that bar. Remember, inside bar usually refers to the bar to the left. So this bar is inside of that bar. This bar is inside of this bar. Here we have what I call an IOI pattern. So we have an inside bar, and this bar is an outside bar. I look at this as an inside bar inside of this bar. We have inside, outside, inside, and it's a breakout mode pattern. In fact, I would call this IOII because it's an II pattern. An outside bar and a pair of inside bars, and the outside bar is preceded by an inside bar. It's just a sign of a market looking to break out. So IOI, inside, outside, inside. IOII, inside, outside, inside, inside. You can also get an outside, inside, outside bar. I know it's getting confusing, but sometimes that's what you get. We have an inside bar here, which means this is an outside bar. So we have an outside bar, inside bar, another outside bar. So this is an OIO setup. Again, it's just a sign of a sideways market that is trying to break out or getting ready to break out. It's a breakout mode setup. This chart, there are many inside bars and there are several II patterns as well. Inside bar, inside of another inside bar, so it's an II. And here's another II here. This bar is inside that bar. This bar is inside that bar. Breakout mode. Sometimes you get reversals. Here, bear trend, and then II, and it ended up ultimately reversing up. It went a little bit lower, but ultimately reversed up. IOI, you have an inside bar here, and this bar is outside that bar, so it's an IOI pattern there. And where else? Over here, we have an inside bar, and this bar is outside the prior bar, so we have a pair of IOI bars. Again, breakout mode patterns. Any small tight trading range like this can be a signal, but the context has to be good. So if it's occurring in the middle of an extended tight trading range like this, the probability that the setup will lead to a breakout is small. But if it's occurring late in a trend, you have a better chance of a reversal. Most of the time, when you get II patterns or IOI or any of these small tight trading range patterns, they're occurring within bigger tight trading ranges or extended tight trading ranges, and they are meaningless. Outside bars, there are lots of them on this chart as well. This bar is an outside bar. Here's an outside down bar. It reversed up. Here's a big outside down bar. These arrows show all the outside bars, or a lot of the outside bars. And for the most part, they do not have any predictive value, and they're just a sign that the market is going sideways. It went up and went down. Or it went down and then it went up here. It's usually part of a trading range. You need context. These small signal bars, these small tight trading range patterns, very common in trading ranges, and they do not have any meaning. But if the context is right, they can lead to a swing up or down. Inside bar, inside the prior bar's range. Here are several inside bars on this chart. II, consecutive inside bars. There are a couple up here I showed earlier, up here and then down here. IOI, an inside bar after an outside bar. Over here is an example, and then over here, another example. So an inside bar following an outside bar. An outside bar, it engulfs the prior bar's range. Many examples here. Now I said that these small tight trading ranges, IIs, IOIs, any of them can lead to reversals or breakouts. But what's key is the context. What do the bars to the left look like? Context is all of the bars to the left. Here we have a small inside bar, and the bar before it is also an inside bar, so it's an II pattern. Remember, the inside bar can have a low at the low of the prior bar. The inside bar, its low has to be at or above the low of the prior bar. So even though this bar has the same low as this bar, it's still an inside bar. And when I talk about good context, I mean the bars to the left make it reasonable to expect a swing up or down. For example, what's the context here? We have a bull trend, but the bull trend went sideways and formed an expanding triangle. Low, low, lower, and then a series of higher highs. And we broke above it, and the breakout might be failing. Both II bars are closing on their lows. This is a reasonable sell setup, looking for some kind of a swing down. So you sell with a stop just below the low of that second inside bar. Before, I talked about small bars as being trading range bars, especially if they overlap prior bars, and that's the case here. But they're trading range bars after a bull breakout, and the trading range only lasted 3 or 4 bars. So it's a pullback. Therefore, the trend is likely to continue up. And in this particular case, we have a bull trend, a pullback, a breakout here to a new high, and this pullback is testing the breakout point. So it's a breakout pullback or a breakout test. And this is an inside bar following an outside bar. Even though it's barely an outside bar, it is. But it's an IOI bull flag. Bull flag because we have a bull trend and not enough bars to be 50-50. The odds still favor the bulls. So whenever a trading range is small and it's occurring in a trend, chances are it's simply a pullback in that trend. Bull breakout, a pullback testing the breakout point, creating a gap. Even though this low touched that high, to me, it did not drop below that high, and we were trying to reverse up here. This is a potential start of a swing up. Talking about good context, what's bad context? Here, we have a strong bull trend, and then we got the biggest bull bar coming late in the bull trend. And we have a gap, this low, this high. Is this bar more likely a measuring gap leading to a measured move up? Or is it more likely an exhaustive end of the trend that will be followed by a closure of the gap, a sell-off down below the high of this bar? Usually when you get a big bar late in a trend, it's more likely to be an exhaustive end of the trend than the start of a new leg up. Here we have an inside bar, inside of an inside bar, inside of another inside bar. So this is an III pattern. But it's an III following a very big bull bar late in a bull trend. So it increases the chances that it is an exhaustion bar here and that this will lead to a reversal. Traders will sell on a stop below the low of that bar. They'd get filled on this small doji bar, and then we got a strong breakout below the III, and at this point we have a reversal. We went up and we went down, and we'll probably at a minimum get to the low of the biclimax bar, and we may fall for a measured move, which we did. Context, really important. Here we have another IOI pattern, inside bar following outside bar, but look to the left. It's a 20 bar tight trading range. Should I sell below the low of this bear inside bar? No, because chances are the sell-off is not going to go very far, and it may not even go far enough to make a scalp. It's not a reversal pattern. There's nothing to reverse. We're going sideways. Chances are, if we break out, we'll simply go more sideways. Markets have inertia, and they tend to continue what they've been doing, especially if they've been doing something a long time. And we've had a tight trading range here for 15 bars, very small bars, better to wait for the breakout than to place any trades in here. You can see it lasted another 20 bars and still didn't break out. And this range probably is too small, even to make money scalping using limit orders. Outside bars, you got to be really careful with outside bars. They are often traps. You need good context if you're going to be trading them. Because think about it. Let's say you look at this bear trend and we get a reversal up. And you say, wow, that's a great looking bull reversal bar. It is, but it's following 5 consecutive bear bars with no pullbacks. So this is the first pullback after 5 consecutive bear bars. If you just look at that bull bar, you say, I'm going to buy right above the high of that bar. Well, it's also the first pullback after 5 bear bars. This is not good context. Think about that as well. It's a big outside bar. So if you buy up here, your stop is here. That's far. So your risk is big. And because it's following 5 bear bars, the probability of a profitable long is low. If you buy up here above the high of this bar, you're taking a low probability trade with big risk. Big risk means bad risk reward. You're buying a trade that has bad risk reward and bad probability. That is a bad trade. More likely, you'd make money selling up there. I personally would not buy that. If anything, I would be prepared to sell. Bad probability because you're following 5 consecutive bear bars, several closing at or below their midpoints and near the lows of the bars. And you got big risk. Chances are bears will be looking to sell above this bar, betting that it's a trap, that it will trap bulls into buying too high in a low probability trade. We went up a little bit, around a 50% pullback, and then we started to go down. Outside bar, bad context, probably not reversal, probably sideways, maybe even down. Not a good buy setup. I said earlier that outside bars are very common within trading ranges. Here's an outside bar. Here's another outside bar. And it's just part of a tight trading range. They occur very commonly in trading ranges. Trading ranges are constantly trying to break out. And sometimes the breakout can be a single bar and it ends up as an outside bar. In a tight trading range like this, instead of selling below the low of that outside down bar, you make more money buying with a limit order at its low. Same here, outside down, nobody's going to sell below. I'm not going to sell below. So many bulls wanted to buy it that they bought the close. So as soon as that bar closed, look what happened. The next bar opened at the close and raced right up. Traders saw it as a bear trap, and they were so eager to buy that they didn't even try to buy below the bar. As soon as that bear bar closed with that tail, traders bought the market. Pretty good size outside down bar, but at this point, it's a 10 bar trading range. And if you sell below, you're selling at the bottom of a tight trading range. trading range, you want to buy low, sell high, and scalp. So selling below that bar is the exact opposite of what traders should be doing. If anything, if they're going to be taking any trade here, they buy with a limit order at that low, betting that the trading range will continue. And since we're at the bottom of the range, if the trading range continues, probably it's going to go up far enough for at least a scalp. Bulls will place a limit order to buy the low of that bar. Outside bars, if the context is good, they can be good signal bars. Again, look to the left. Here we got a bull trend and then a sideways pullback. We went down, pullback, down a little bit more, and then we reversed up strongly with an outside bar. Remember, in general, I don't buy above the bear bar. I like to buy above bull bars if I'm buying a pullback in a bull trend. So to me, the buy is above the high of this bar. We went down, we went up. It's a 2-bar reversal. On a higher time frame chart, it's a single reversal bar, and the buy is above the high of the 2 bars. Usually it's better to buy above the high of the bull bar. In this case, the outside bar is the bull bar. Traders place a buy stop just above the high of that bull bar, and then they get long on this bar as it goes above the high of the 2-bar reversal. I want to talk a little bit about II patterns and breakout mode. Big bull reversal, and we have an inside bar followed by another inside bar. Well, same thing here, bear breakout, inside bar followed by an inside bar. So both are II patterns. And whenever I see an II pattern, I always assume that it is a triangle on a smaller time frame chart. So if this is a 5-minute chart, you can look at a 1-minute chart, and it probably is going to be a triangle on a smaller time frame chart. As I said before, if you get 3 I's, I, 3 consecutive inside bars, and then you can get 4 consecutive inside bars, I. Doesn't matter, 2, 3, 4, it's all the same. They are triangles on smaller time frame charts, and they all represent breakout mode. And since we have a bull trend here, chances are the bull trend is going to resume. This is, to me, not a very good short below that II. And then we got 2 legs down, 1 pullback, 2. Here, I would start thinking about buying. We're trying to get a bear breakout to reverse this. As good as this bear bar is, it's small compared to this. And look at the follow-through bar. It's a bull bar. That is a problem. It increases the chances of a failed breakout and 2 legs down, 1 sideways, 2. Let's say this is a 60-minute chart. And we have an II pattern over here. I said II patterns are triangles on smaller time frame charts. Not always, but probably 90% of the time, if you look at a smaller time frame chart, you'll see a triangle. So here's a 5-minute chart. And a triangle simply means there are 3 pushes down or 3 pushes up. Here we have a little push down, second, third. Here we have a push up, second, tiny third. So to me, this II on the 60-minute chart is simply a triangle on the 5-minute chart. And you can see what followed. We got a bull breakout above the triangle. Remember, I also said this is 2 legs down, so it's a high 2 bull flag. So leg 1, sideways, leg 2. And it's a high 2 bull flag. Not great to buy above the bear bar. Better to buy above a bull bar, like above that or above this. Here's a second entry buy for the II. And the second entry is IOI. Doesn't matter what you call it, but it's a second entry buy. This is a higher probability buy, buying above this bar. You can take that buy, but here we got another inside bar, and a lot of traders would place a buy stop to buy just above its high. This is the entry price for the traders who took the buy right there. And you can see the market went sideways for another hour, and that is this. Here's a pretty tight trading range. And the more bars that get added to it, the more the probability becomes the same for the bulls and for the bears. However, whenever you have a tight trading range relatively late in a bull trend, it often becomes the final bull flag. So you get a breakout and the breakout reverses. anytime you see a tight trading range late in a bull trend, you always have to be thinking about a final bull flag. Here is an II pattern late in a bear trend, but it's also a higher low in a bull trend. The context is pretty good for the bulls. 2 legs down, 1, pull back 2. We have a bear breakout with a very big tail. And then we have a bull bar for the second inside bar closing on its high. So this is a reasonably good buy setup. Better than a 50% pullback, a higher low well above the bottom of the bull leg. Strong sell-off, higher low, yes, but strong sell-off. If I'm buying, I prefer to see the II have a good bull bar for its second bar, and it did here. The second bar of the II is a bull bar closing on its high, so that's a higher probability buy setup, buying as the next bar goes above the high of that buy signal bar. There's another II over here, and you can argue higher high, major trend reversal, bull trend, bear breakout, higher high. Really not enough bars for a major reversal, but it might still be a major reversal. It's reasonable to take that short. You're also a double top here. You can call this a bigger higher high major trend reversal. Bull trend, bear breakout, higher high here, double top, higher high. Or you could say bull trend, bear breakout, higher high. But anyway, you're at the top of a trading range. You have a double top here. You have a bigger double top here. You have a major trend reversal for this bull trend, a bigger major trend reversal for this bull trend, and then you have a bear bar in an II closing on its low. So the second bar of the II is a bear bar closing on its low. To me, that's a good sell setup. You sell just below the low of that bear bar. That bear close on the second bar increases the probability that the short would be profitable. Take a look at this slide. We got a bull breakout, a pullback, and a second bull breakout, and we are accelerating upward. A lot of bulls will buy closes, but if they buy this close of this strong bull bar, they know it's a second leg up, and therefore it could possibly lead to a trading range or a reversal. And then right after they buy, they see a bear bar. Even though it's a doji, it's still a bear bar. The buy the close bulls are nervous. They're disappointed. They're afraid that we might reverse down very soon. So a lot of them try to get out break even at the original entry. And here we have an II pattern. The second bar, although it's not a bear bar, it's still not a good buy signal bar. So these buy the close bulls now have 2 bars that are disappointing, and they're going to be thinking about maybe trying to get out break even. Bad follow through, bull bar, and then 2 bars sideways. Neither one has a bull body. And second leg up. This could be a trap, and buy the close bulls are going to be thinking about trying to get out break even. II is a 2-bar tight trading range, and like any tight trading range, it represents balance between the bulls and the bears. An II pattern, a tight trading range, it can be the final bull flag. Even if we do get the bull breakout, traders will be thinking 1 push up, 2 pushes up, maybe we'll get 3 pushes up into a parabolic wedge top and a reversal down. And again, you have disappointed buy the close bulls who are hoping for any kind of a bounce so that they can get out break even. This II represents balance, bulls and bears balanced. If the market gets away from that balanced area, it might come right back to it, and therefore it could be a final bull flag. Remember, we got a bull trend and we have an area of balance, and it could be the final bull flag. If the market breaks to the upside, it can come back down. And because it's the third push up and a possible wedge top, this small II could lead, in fact, to a trend reversal, not simply sideways. So a final flag reversal can lead to a reversal and not simply an end of the bull trend. So you get disappointed by the closed bulls, and now when they see this bar, a lot of them place a limit order to get out break even. Did not get filled on the second bar, did not get filled on the third bar. And these bulls are getting really nervous. They still have their limit order trying to get out break even. And look what happened here. It got right to that close, but not above it. The bulls who tried to get out break even failed, and they're giving up here. Some of the bulls saw these 3 bars, no bull body. Instead of trying to get out break even, they wanted to get out with a minimum loss. So they'll place a limit order to sell out of their longs above the high of the prior bar. And that's what happened here. This bar went a little bit above the high of the prior bar, and immediately reversed down because you had bulls giving up. And this is a give up bar. Now we have 4 bars without a bull body, 3 of them bear bars, and this one's closing closer to its low than that one, and this one is closer to its low than this one. Probably the bulls are in the process of giving up, and you can see what happened. They gave up on this bar and this bar. Sideways here, the bulls were hoping for any kind of a bounce that would let them out with a smaller loss. Bears were hoping for any kind of a bounce so they could sell higher. Both bulls and bears wanting to sell. It could not go higher. It just went down. It trapped the bulls into a bad buy, and they had to exit quickly here and here. This is an outside. We have an II here. This bar is outside that bar, and this bar is outside that bar. And in this particular case, outside bar in a tight trading range, the context is such, you know by the closed bulls were desperate to get out. By the close of this bar, you know the odds are we're going lower. The bulls could not get out break even. So the ones who did not get out with a small loss above that bar are desperate, and they are going to sell. Now here we have a bull trend, and then we have an IOI. This bar went a little bit above that bar, so it's an outside bar. And this bar is clearly an inside bar. You think, well, maybe buy climax and sideways. Yes, but we have about an 8-bar bull micro channel. Bear bar trying to reverse down, almost certainly going to be bought. You can see they bought the low of that bar, creating this tail here. And bulls are expecting trend resumption up. They see an IOI, but they're going to assume it's a bull flag. And with the 3rd bar being a bull bar, especially closing in its upper half, a lot of bulls will buy above its high. They'll put a stop way down here, thinking that maybe we'll get a couple legs down, 2 or 3 legs down. But even if we do, we'll still probably resume up. And you can see what happened. The bulls bought here. We pulled back a little bit more. Other bulls bought here. Now we have a small double bottom bull flag, a high 2 bull flag, and the market accelerated upward. Here, the bears tried to reverse. They could not even get below the moving average. So this is a pullback to moving average in a bull trend. You have a high 1 and then a high 2 buy setup at the moving average in a bull trend, and both the high 1 and high 2 signal bars had bull bodies. Any bears who shorted, they might hold short after the first resumption up. They're going to get out after the second resumption up. And that's one of the reasons why a high 2 bull flag just above the moving average with a bull buy signal bar is a high probability trade. So yes, IOI is breakout mode, but it's in a bull trend above the moving average in a bull 3rd bar. Breakout mode, but probably you get a bull breakout. Now I talked earlier about IOI patterns, and if you're looking to buy, it's higher probability if you're buying above a bull bar for the 3rd bar. Here we have a small IOI. 3rd bar is a bull bar closing on its high. It's a higher probability buy than if it was a bear bar. Same here, another small IOI. Here, another IOI. And again, bull bar closing near its high above the moving average in a bull trend. It's a channel, but still higher lows and higher highs. So it's still a bull trend. Buying above a bull bar above the moving average is a reasonable buy. And the IOI is a pause in the bull trend. It represents some equilibrium between bulls and bears, but the probability still favors higher prices. When you see an IOI and the 3rd bar is a pretty good looking bull inside bar closing on its high, it's a good buy setup. Here we have an IIOI. So we have an IOI where this bar is actually outside of that bar. Irrelevant. It's a small pause in a bull trend. The odds are we're going higher. And then if we have an inside bar at the end of the tight trading range, closing on its high just above the moving average, it's a reasonable buy. This is a more typical IOI in a bull trend, so it's a buy above the high of that bar. Here's an IIOI. Again, I wouldn't worry too much about the terminology. All you have to know is the market's going sideways in a bull trend and not too many bars. It's probably a pullback and not a trading range. Remember, if a pullback starts to grow to 20 or more bars, the probability of a bull breakout falls to the same as for a bear breakout. But as long as the pullback is only 3, 4, 5 bars, the odds still favor trend resumption. Since this is a bull trend, these little pullbacks probably are bull flags. It's more likely that we're going to continue higher. The opposite is true in a bear trend. Here we're getting lower lows, lower highs, staying mostly below the moving average. Traders are looking for sell setups. They want to sell below bear flags. Double top, bear flag, low 2, low 1, low 2, micro double top here. Doesn't matter what you call it. We're going down in a channel, lower lows, lower highs, and we're stalling at the moving average. This is an IOI, so we have an inside bar following an outside bar, and it's just below the moving average. Does not have a bear body, but it does not have a bull body. I think it's a reasonable sell setup. Bears will place a stop order to sell just below the low of that bear bar, and they get short there. Same thing over here. Again, we have an III over here. Just below the moving average, bears will sell with a stop just below the low of that bar. Anytime you see a small tight trading range, 2 bars, 3, 4, 5 bars, with small bars, the market's in breakout mode. Let's say this is a daily chart on the left. And then we have a 3-bar tight trading range. It's not really an II because this bar is not inside that. This high is above that high. And it's not an IOI because this low is above that low. It is a small tight trading range in a bull trend. It's also a third push up, 1 pullback, 2 pullback, 3, and bad follow through, bull bar, bad follow through, bull bar, bad follow through, bull bar, bad follow through. So you got to be thinking that this might lead to a reversal. And these patterns, even though it's not a perfect II or IOI or any of those other patterns that I talked about earlier, it's a 3-bar tight trading range, and it probably is a triangle on a smaller time frame chart. This is a daily chart, and this is a 4-hour chart, a 240-minute chart, and this pink rectangle is this, and you can see 3 pushes down, 1, 2, 3, so it's a triangle. Again, any small sideways pattern can be a breakout mode pattern, and they usually are triangles on some smaller time frame chart. And when they come late in a trend, you have to be thinking about a possible reversal. In this video, I talked about tight trading ranges as setups, breakout mode patterns, and then I also talked about II patterns and breakout mode. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 4 videos on candles, setups, and signal bars. I'm Al Brooks, and thank you for watching the Brooks Trading Course. This is the 4th of 4 videos on candles, setups, and signal bars. I'm first going to talk about what a setup is, and then I'll make a point about weak setups needing more than just the setup alone. Next, I'll move on and talk about second signals. So there's a signal, and then the market did not go very far, and then the signal triggers again the second time. And finally, I'll talk about counter trend trades and how the probability improves if there is a strong signal bar. When you're trading, you often see good-looking signal bars. Here's a good-looking buy signal bar. Here's another good-looking buy signal bar. Well, here's a good-looking bear bar, good sell signal bar. And a strong candlestick bar is not enough to take a signal. Here, the traders are being offered good buy signal bars, but we're at the top of a trading range, so the context is not good. Trading range, you want to buy low, not high. In general, markets have inertia, and if they're sideways, chances are they'll continue sideways. So buying at the top, hoping that a breakout will be successful, is a low probability bet. Always look to the left. The left is the context. And if the context does not support the trade, then your trade has a low probability of success. More likely, if the market goes above the high of either of these bars, it will only go up for a bar or two, and the trading range will continue. Remember, in a trading range, you want to buy low, and you want to sell high, and traders lack conviction. The one thing they're confident of is that the market's not going to go very far up or down. And because they believe it's not going to go very far, they take quick profits, they scalp. Because most breakout attempts fail when you're in a trading range, buying at the top, even if the leg up is strong, selling at the bottom, even if the leg down is strong, is a low probability bet. You'll probably lose money because the market will probably reverse. For a trading range, it's a bad environment for swing trading. By the time you're convinced it's going down, well, guess what? You're selling at the bottom of the range. It's the buy zone. By the time you finally see a strong move up and you think it's going higher, well, you're then in the sell zone. Follow through is probably going to be bad, and the trading range will probably continue. It's better to bet that the market will reverse and that the breakouts will fail than to bet that they will succeed. 80% of breakout attempts within trading ranges fail, so it makes more sense to look for a reversal trade. Here, very good looking bull reversal bar, another very good looking bull reversal bar, but in a tight trading range at a pair of prior highs. When the market was up here, it sold off. Same price level, sold off. Same price level, failed. Buying, despite these two bull signal bars, is a low probability bet because the market keeps selling off at this price level. You're buying at the top of a trading range, and you're also buying at the top of a tight trading range within a bigger trading range. Chances are there are more sellers above than buyers. Even though you have a good buy signal bar, you have bad context. Likewise, look at this. We're selling off, and here's a pretty good looking bull signal bar. Here's another pretty good looking bull reversal bar, buy signal bar. But what's the problem? You're in a very tight bear channel. You look to the left of these bars, and the market's in a very tight bear channel. Therefore, any reversal, if it reverses at all, will probably be minor. Traders should only be looking to sell, not looking to buy. The context is bad, so a signal bar alone is not a reason to take a trade. Here, we're selling off strongly, and we have a good-looking sell signal bar. Maybe it's okay, but trading range price action here, we went down, we went up here. Here's another sell opportunity. Head and shoulders top bear flag, left shoulder, head, right shoulder, but you're selling at the bottom of a tight trading range. Good-looking sell signal bars at the bottom of a trading range, low probability bet. Likewise, good-looking bull bars here, but look to the left. A lot of trading range price action. Where are the consecutive big bull trend bars? We have a couple here, but since then, the bull bars have been small and have been followed by bear bars. So betting that this is the start of a bull trend is a low probability bet. Good-looking buy signal bars does not mean traders should buy. Look to the left. We're in a tight trading range here, and it's within a larger trading range. It's better to be looking to sell when the market's at the top, better be looking to buy when it's at the bottom. Strong bull trend. About a 10-bar bull microchannel, another bull microchannel. What are the chances that this reversal is going to lead to an opposite trend or even a profitable trade? The same with here. How many bear bars have there been in the past 15 bars? 3, and they're all small bodies. And the channel up, the bull channel, is very tight. These are very low probability shorts, even though you have a pretty good looking sell signal bar right here, a bear reversal bar. Here you got a reversal bar. The close below the midpoint of the bar has a small bull body, but a big tail on top. Could be a decent sell signal bar, but the context is terrible. Look at the bars to the left. You should only be looking to buy. Reversals like this will fail within a few bars, become bull flags, the trend will continue up. Here you get a reversal bar, and the market went sideways for many, many bars. Third push up here, 1, 2, 3, so it's a wedge top, but tight bull channel. The reversal probably minor, and a minor reversal usually leads to a trading range, not a profitable short. Now, in a strong bull trend, a lot of times the buy signal bars are not all that good. This is pretty good here. A decent bull bar closing on its high, but look at this. It's a doji after another doji after another doji. In a strong bull trend, a lot of times the buy signal bars are not good, yet you should still buy them because the trend will continue higher. And a lot of the buy signal bars within bull flags don't look particularly strong. Does not matter. They're still buys. Strong bear trend, tight bear channel, pullbacks are only a bar or so. Don't look for reversals because most reversals will fail. So even though you got a good bull bar here, and here you got a bull reversal bar, it's small compared to the bear bars before it. Look to the left. The bear channel is very tight, not much in terms of big bull trend bars, not much buying pressure. A bull bar, a bull reversal bar, not reason enough to buy. These reversals will fail within a few bars and become bear flags. Instead of buying, you should be looking to sell. Now it's a bear trend, and very often the sell signal bars are not particularly good, and it's okay to sell. Here we have a doji bar, small bar. However, it's in a very strong bear trend. It's reasonable to sell below, stop above maybe the top of the sell climax. So you sell on a stop below the low of that bar, even though it's not a very good looking sell signal bar. The momentum down will probably continue. The attempt to reverse up will probably fail and lead to a bear flag and another leg down. I mentioned that if there's a weak setup, traders usually need more reasons to enter the trade. Here we have a bull trend and a weak buy signal, a double bottom, or simply a pullback from a breakout to a new high. And you can either wait for a stronger looking signal, or you can buy and use an appropriate stop and scale in. An expert trader would not hesitate buying above that bar or above this bar. He'd put a stop down here, and if the market went down further, he would buy more. Sometimes you look at a setup and the signal bar is weak, but the context is also weak. And when both the signal bar and the context are weak, the chance of making a profit is low. And you can increase your chances, you can increase the probability by simply waiting for more information. So here, we're rallying. We have 4 consecutive bull bars, a 7-bar bull microchannel, 8-bar bull microchannel. Do you want to sell below that bar? It's a bad looking sell signal bar. And the context for a short is bad. I would not sell below that bull bar. I would wait for example, a second signal. Here's the first time down. Now we have an II with a bear bar closing on its low. That is a higher probability sell. So instead of selling below that bull bar, maybe sell below this bear II setup, a second attempt to reverse the breakout above these highs. If you want even higher probability, wait until there's a bear breakout or follow through and then sell closes. This bar represents bulls giving up. Bulls who bought that close, disappointed here, tried to get out break even here. Those that did not finally gave up. So sell that close, sell this close, sell at this high over here. That is a higher probability trade. And I understand the argument. If you sell here or here, your stop is further away, so you're increasing your risk. But whenever you increase your probability, you're always going to have a worse risk reward, which usually means the stop is further away. As I said, you could also wait to sell the close of the follow-through bar, or even the high of the follow-through bar and get short right there. Or even this, a weak reversal, second entry buy, but this is strong enough selling, probably a bear flag and another leg down. Strong bull breakout, strong bull breakout. The market's probably going higher. So we get a breakout, good follow through, breakout, good follow through. The market's always in long. If you had to be in the market long or short, you would only pick long. The odds are the market's going higher. Strong bull bar on the breakout. And then the next bar is strong as well. That's the follow-through bar. Another bull breakout, another follow-through bar. It's hard to see, but this little doji has a bull body. And that's important. If you get a follow-through bar with a bear body, you have to wonder if the breakout will fail. But here we got a breakout and the follow-through bar has a bull body. That increases the chances that the market is going higher. So when you see that, you know the probability is the market's going up. Buy for any reason. This whole course is about ways to enter, and you can enter on almost any bar, but you have to think about why you're entering. And in a strong bull trend, you can buy closes. You buy the bull close, buy the bull close. You can buy below a bar, betting the reversal down will fail. You can buy a bear close, betting that the bear reversal will fail. I talked about bad signal bars in a bull trend. Here's a bear trend, pretty strong bear trend. And do you want to buy above the high of this bear bar? No, it's a terrible signal bar and the context is bad. The same is true here. Even though it's a second entry buy, it's still a lot of bear bodies and not much in terms of bull bodies. So strong bear trend, buying is a bad idea. And then buying when the buy signal bar is a bear body is a terrible idea. So you have bad signal bar for a buy, a bear bar, and you have bad context, a bear trend. So we have an 8-bar bear microchannel. This bull bar did not get above the high of that bar, so it's still part of the bear microchannel. The odds are very high that the first reversal up will fail. You certainly don't want to buy when you know it's probably going to fail. And you also don't want to buy because it's a terrible looking buy signal bar. You can buy if you start to get a strong reversal up, but this is not enough. You need more. If you're looking to buy and you do not have good context, here we have a strong bear trend, and you do not have a good buy signal bar, the next reason to buy would be if we get a strong breakout. And at that point, you get a higher probability buy. And look what happens here. Bull bar closing on its high, bad follow through, but still not a bear bar. Bull bar closing on its high, another bull bar. This is a strong enough reversal up so that even if we sell off again, the worst that the bulls probably get is the trading range, which means even if we sell off again, we'll probably come back to this level. Now it's okay to buy closes or buy a pullback. The market's always in long somewhere in here. Chances are, even after a pullback, you'll get at least a second leg up. So you buy for any reason. You buy at the market, you buy a close, you buy the close of the follow-through bar, you buy the low of the bear reversal bar. 8-bar bull microchannel, first reversal down, probably bought. It becomes a bull flag, a failed bear reversal, buy above the high of the bull bar here. Simply buy at the market, right here, right here. You know the odds are it's going higher, buy at the market, stop below the bottom of the bull leg. If you want to allow for the possibility of scaling in, trade small enough so that you can scale in. Buy bull closes, buy bear closes. Here's a bear bar, but an 8 or a 9-bar bull microchannel, the reversal attempt will probably fail. So you can place a market order. As soon as that bar closes, buy at the market. Or you can place a limit order to buy at the low of the bar and get filled on the next bar. We got a bear reversal bar here for a failed breakout above this high. You can argue low 2 short, low 1, low 2. Seriously, do you want to be selling below that bar? It's a small bar compared to these other bars. So it's a weak sell signal bar, even though it has a bear body. And much more importantly is this. There's a 10 or a 15 bar bull microchannel. So the probability of a successful short here is bad. You have a bad signal and you have bad context. To the left, too many bull bars, no bear bars. It still can reverse, but the probability is low. So when you have a bad sell signal bar and bad context for short, it can go down, but you need higher probability. The third thing that the market can do is reverse down. And if you get that, then you can look to sell after you see the reversal. 14 bar bull microchannel, bad context for a short. Higher probability for the bears to wait for a strong reversal down before selling. And that's what we have. Not a strong reversal down here, it's a bull flag, but then we have a bear breakout below the bull flag, and we have a bear follow-through bar, and now we have 4 consecutive bear bars. Now the probability is this is strong enough selling, first reversal up will be sold, and there'll be at least a second leg sideways to down. So now the context is good for the bears. You can either sell the bear breakout. I usually like to wait to see if the next bar, the follow-through bar, has a bear close, which this one does, and then sell the close of the follow-through bar. And traders will sell closes. They'll sell that close. They'll sell that close. Some traders just keep adding to their positions. Other traders take any of those sells and just hold on to it. Other traders will sell, scalp out, sell, scalp out. Always in short through here, so sell for any reason. Not a strong bear trend, but still a bear trend. First reversal up led to a second leg down. Tried to reverse up again, but very tight bear channel. The reversal is probably minor, which means either a bull leg in a bear channel or a bull leg in a trading range. In either case, the market is probably not going to go very far up. Traders will sell the market. They'll sell above bars. They'll sell bull and bear closes. They'll sell bear closes because it's a bear trend. They'll also sell bull closes because they bet the bull reversal attempts will fail. Now, I also want to talk about second signals. Sometimes the context is good enough for a trade, but the signal bar is not strong enough, or maybe the context is not quite good enough. In that case, a lot of times it's better to wait to see if there's a second signal. Here we have a decent bull trend, decent follow through, bear bar, bear bar, bear bar, a wedge, 1, 2, 3, and a bull breakout above the wedge. Chances are it'll fail. Is that a good short? I think it's not all that good. However, in a situation like this, where you get a wedge, increases the chances you get some kind of a pullback. You have a couple bear bars on the way up. You have a good-looking sell signal bar here. Makes me think we're trying to get a pullback, but I'd like to see one more sell signal before I take the short, and that's what we get over here. Another bear bar closing near its low. That is a second signal, and it's a higher probability short than this one. So a lot of traders in a situation like this, where the context is not particularly good for a short, even though there's a good sell signal bar, a lot of times they'll wait to see if we get a second signal. So now we have a double top. Bulls buying closes, disappointed here. You have to assume they'll try to get out break even, which they did on this bar. And then look at this. The bulls are selling, so we got a micro double top and a bear bar closing near its low, probably going to go lower. At the bottom, 1 push down, 2 pushes down, 3 pushes down, a double bottom high or low, parabolic wedge bottom, and a higher low double bottom, but a very tight bear channel. Do I want to buy above this bull bar? Does this bull bar look big enough to reverse these two bigger bear bars? Probably not. I probably would not buy above this bar. The bears tried to resume again, but immediately the bulls got another reversal bar. So buying above this bar is a second entry buy and a higher probability for at least a scalp up. The market's in a trading range, and it's near the bottom, but a fairly tight bear channel here, about a 5 or 6, well, maybe 6 or 7 bar bear micro channel. You can argue micro double bottom, and it's a buy. Well, it's only a doji bar and maybe a 7 or 8 bar bull micro channel. In general, if I'm not certain, I wait for a second signal. So there's the first signal. Did not go very far up. The market tried to sell off again, immediately reversed up, a bull bar closing on its high. So this is the second attempt to reverse up. This is a second signal and has a pretty good buy signal bar. So this is a higher probability buy above the high of that bar. Whenever there's something wrong with the first signal, just wait for the second signal. The probability then is higher. Do you take profits up here? We have a micro double top, up, down, failed breakout above a trading range, a double top lower high here. So we're probably at the top of a trading range. A lot of traders, if they bought there, would exit below that bull inside bar or maybe below that bear bar. Bull trend over here, bull trend, a bear breakout and a higher high. Should you take this as a higher high, major trend reversal? Well, a couple problems. The pattern does not have many bars. The bear bars are not particularly big, so I would not expect much of a reversal down, not much selling pressure. Selling below this bear bar, especially a weak-looking bear bar, is a low probability bet. Wedge top, 1, 2, 3. You got 6 bar bull micro channel here. No big bear bars here, not much selling pressure. It's a low probability bet selling below that. Here, now we have a micro double top. This bar and that bar. Selling below this bar would be a second entry sell. Bull body, tight trading range, still not a great sell, but the probability of making money selling below this bar is higher than below that bar. If you really want high probability, wait to see if we start to break to the downside and then sell. And that's what we got. After 3 or 4 bars down, the market's always in short. Traders believe it's going lower, so if they have to be in the market, they want to be short. They'll look for reasons to sell after this 3rd or 4th bar. They'll sell closes, they'll sell at the market, they'll sell bear closes, they'll sell bull closes. Small bear breakout, close below the low of the past 6 bars or so, 7 bars, that's good. Bar closing near its low, good. Next bar has a bear body, closing at its middle instead of at the top. It's good to close around or below the middle. Good follow through selling. Traders will start selling closes. They'll sell bull closes, betting that the first reversal up will fail. And they'll sell below bars. Here we have an II with a bear close. So it's a small bear flag, a failed bull reversal attempt. Traders will place a stop to go short just below this bar, and they'll get filled over here. Here we have another attempt at a lower high major trend reversal. Bull trend, bear breakout, decent bear bars. We have 5 or 6 bear bars here. And then the rally, not particularly strong, not big bull trend bars closing on their highs. 4 or 5 consecutive bull bars, good. So it's a low probability short, but the context is good. A lower high or a double top major trend reversal. Look how small this bar is. And that's important. So you say, well, Al, I can just short below the low of this bar and put a stop above the high of the bar, and my risk will be tiny. Whenever you have a very, very small risk, you should always assume that your great risk reward comes hand in hand with low probability. If you sell below this bar and put a stop just above it, your risk is very small. You'll probably lose money, because if you have a great risk reward ratio, chances are the probability of making money is very small. How do you increase your probability? Well, you got a couple ways. You can wait until there's a reversal down and then sell, or simply use a wider stop, and especially be willing to scale in higher. So low probability does not mean no probability. It just means the probability is low. Sometimes you get lucky. Big bear breakout, close below the low of at least these 5 or 6 bars. I can't see. Maybe it closed below the past 20 or 30 bars. In any case, big bear bar, big bear breakout, and then the follow-through bar also has a bear body. At this point, the probability is we'll get at least a small second leg down. This is a low probability short below that bar. Well, after seeing the bear breakout and a bear follow-through bar, the probability is now high that we're going lower. Bigger bar, so if you wait to sell down here, yes, you're getting a higher probability of success, but your stop is further away, which means you're increasing your risk reward. And that's okay. I'll take a high probability trade anytime, even though the risk is often greater. The stop is further away. The probability is if I manage my trade well, I'm going to make money. Sell climax and a bull reversal bar and a bull inside bar. Low probability bet. Tail on the top of the buy signal bar, doji here, probably minor reversal, which means a bear flag and another leg down. Chances are when you see this, 4 bear bars, the bodies are increasing in size. We got a big bear bar here, first reversal up, even with a good buy signal bar, probably a minor reversal, which means a bear flag that will be followed by another leg down. So if you have any doubt, wait for a second entry. Same with down here. Can you buy this? Well, you got 2 big bear bars, bigger bodies than that bull reversal bar, tail on top. You can argue 2 legs down, big bear breakout, expect at least a second leg down. Well, you have your second leg down, so maybe we'll reverse now and get up here. But after these 2 big bear bars and a 6 or 7 bar bear tight channel, that's not a high probability bet. When in doubt, wait for a second entry. What about buying above this doji bar? Still not a very strong buy. You can wait again for another second entry, which would be a third entry. And here you got a good looking buy signal bar closing on its high. You can call it a high or low. You can call it a double bottom with this. You can call it a second entry with this, second entry or third entry with this. In any case, the probability of making money is higher buying here than it is buying above that doji or buying above that bull bar. You enter with a stop just above the high of that bar and protective stop below, and you catch the swing up. Whenever you're trading against a trend, it's always better to have a strong signal bar in your direction. Here we have a strong rally and then a strong sell-off, possibly a double bottom, but this is not a good-looking buy signal bar. We have 6 consecutive bear bars, low probability bet buying on a stop above that bear bar, even though double bottom. But look at this. The bear's got a breakout below the low of the past 40 bars or so, and then it was immediately followed by a bull inside bar closing near its high. Buying above this IOI setup, above this bull bar, it's a higher probability. It's a second entry buy. Here's the first entry buy. Not good. We sold off for new low, but the bulls bought it, and we ended up with a pretty good looking buy signal bar. Buying above this bar, it's a better looking buy signal bar, plus it's a second entry buy, so it's a higher probability buy. This is the buy signal. Traders will place a stop just above its high, and they'll get long on the next bar if the next bar goes above. And it did. The bulls bought the second entry buy, and they got the swing up. Strong bull trend, no bear bar in about 10 bars or so. Do I want to sell below this bar? No. Do I want to sell the second entry below this doji? I personally would not. It's not a strong sell signal bar, and the bull channel is still tight. Probably the best the bears get is a trading range. If you're in doubt, it's better not to sell below weak sell signal bars like this bull bar or this doji. There's just not enough selling pressure. Only one bear bar in the past 10 bars. Chances are the best the bears get is sideways, and that will get another leg up. And we got it. And look what happened. We got the second leg up. Good looking bull reversal. But now we have a bear bar closing on its low. And this bar, it's a higher probability short. Possible final flag, wedge, 1, 2, 3, and a decent sell signal bar. It's still not yet high probability, but it's an okay short. And the probability of making money selling below that bear bar, getting filled over here, is higher probability than selling below that bull bar or this doji. Okay, we got a bear trend, and we have a tight trading range. A tight trading range late in a bear trend often becomes the final bear flag. Also, there's buying pressure. A tail, reversal up, a lot of bull bars in here. That increases the chances that a bear breakout will fail. And maybe this is the failed bear breakout, slightly lower low, major trend reversal, but only a doji buy signal bar. It has a bear body and it's following a bear bar and another bear bar, and this is a big bear bar closing near its low. So a low probability buy. You don't buy it, you wait. And we got our bear breakout. We got a bear breakout here, another one here. We have a potential final flag and 2 legs down. And now we have a pretty good looking bull reversal bar, a bull bar and a reversal bar for a possible low. It's the second attempt to reverse the breakout below this low. We broke up below the low, bad looking reversal. We broke further down and we have a better looking reversal. This probability is higher for the bulls than that one. So it's a better looking buy. Higher probability, wait to see if we reverse up strongly and then buy later. But this is an okay buy. Probability would be higher buying up here. And you pay for it with a stop further away. That's always the case. In this video, I talked about what a setup is. I also talked about weak setups and the need for additional reasons to buy or sell if the setup is weak. Second signals, sometimes the first signal is not strong enough given the context, so it's a higher probability trade waiting to see if there's a second signal. And if you're trading counter trend, it's usually better to only take the trade if you have a strong signal bar. I'm Al Brooks, and this is the 4th of 4 videos on candles, setups, and signal bars. Thank you for watching the Brooks Trading course.